As we mentioned in an earlier video, inventory is so important that we have to constantly keep an eye on it and control it and analyze its activities. We don't want to have too much inventory, but we also don't want to have not enough. If we have too much inventory, we are going to incur various costs, including storage, interest if we have to finance the purchase, costs associated with obsolescence, potential situations where we might have lost or stolen inventory. If we want to be very conscientious and minimize the amount of inventory we have, the problem we may end up with is if we don't have enough inventory, our customers will go to some other vendor to purchase inventory. Now, you may have heard in other classes the term just-in-time inventory. Yes, we can control the inventory in just-in-time so that we have neither too high or too low inventory. However, it takes some level of sophistication to make sure that you have enough inventory available that we have inventory when we need it at any given time. So one of the things that we should look at in inventory is ratios. We take a look at two ratios here, the inventory turnover ratio or the days in inventory ratio. You may have heard the term turnover before. If you've worked in the restaurant industry, restaurants can determine their profitability by the number of times a table turns over in an evening. A restaurant with a very low gross profit percentage will require a higher turnover in order to ensure a profitable operation, whereas a restaurant with a higher gross profit percentage will not require as much turnover in its tables in order to be profitable. So when we look at inventory turnover, what we're looking at is the number of times a company in a period purchases inventory and in turn sells the inventory. So in other words, if an inventory turnover ratio of 12 would mean that in a 1-year period of time, the company purchases and sells inventory 12 times in a year. So the formula is cost of goods sold divided by average inventory. The other ratio related to inventory turnover is days in inventory. In days in inventory, you take the inventory turnover ratio included in the formula 365 days divided by the inventory turnover ratio. And what that tells you is how old the average inventory is or how long it takes the inventory to sell. So here's an illustration. Wal-Mart, known for high turnover. We have an ending inventory in 2011 of $36 million and in 2010, $32 million. The cost of goods sold of $315 million. So if we compute the inventory turnover for Wal-Mart, we see that Wal-Mart turns its inventory 9.1 times a year in 2011. In 2010, Wal-Mart turned over its inventory the same rate of 9.1. Looking at Target, one of its most aggressive competitors, Target turns its inventory 6.2 times. When we look at that, we can see that Wal-Mart purchases inventory and sells it at a faster rate than Target. On the other hand, as we take a look at the days in inventory, it takes 40.1 days for Wal-Mart to sell its inventory, whereas in Target it takes 58.9 days to sell its inventory. So from a shareholder's perspective, if we were looking at these two companies, we can see that Walmart by far sells more product than Target. So one of the other areas to think of is LIFO. Remember we said that LIFO in times of rising prices will require a company to recognize that their cost of goods sold is higher and their net income is lower. So one of the requirements that companies have to do if they are using LIFO is to compute a LIFO reserve. So as it says here, companies using LIFO are required to report the difference between their inventory reported using LIFO compared to FIFO. That difference between the LIFO inventory and the FIFO inventory is called the LIFO reserve. The LIFO reserve is a number to consider what the difference would have been if the company was using FIFO. Not that we're going to make a change, but just to know that if we were following physical flow, here's the difference in what the cost of goods sold and what the ending inventory values would be. Here is an example of what LIFO could do to the current ratio of a company if they were using LIFO instead of FIFO. If the current assets were 38,128 in current assets and the current liabilities were 28,561, the current ratio will be 1.33 to 1. When we take into account LIFO and we add in the LIFO reserve into the current assets, the current ratio changes to 1.42 to 1. In other words, what we see here is that the current ratio would be higher if a company was using FIFO instead of LIFO. Now that could be significant to someone who's looking at either investing or lending money to a company. So let's take a look, as we mentioned before, about the difference between periodic and perpetual inventories. Very similar to before, where we showed that Houston Electronics had $12,000 in goods available for sale. But now show where we show the dates of the transactions of the beginning inventory purchases and sales. If the sale occurred in September, we would have to recalculate the FIFO, LIFO, and average inventories after each transaction. So let's take a look. If we were to use FIFO, the January beginning inventory of 100 items at $10 would give us a balance of $1,000. When we do the purchase in April of 200 items at $11 or $2,200 in purchases, our balance of inventory on April 15th includes the 100 items that we purchased at $10 in the beginning inventory plus the 200 items at $11. The total of the 300 items is $3,200. We would do the same thing for the August transaction, showing that we still have the 100 units at 10, the 200 units at 11, and the 300 units at 12. Total at August is an inventory balance of $6,800. Now when we take a look at the September 10th sale, not looking at the sales price, but rather look at the cost. Because we're doing FIFO, we would have to cost out the inventory first in, first out. If we sold 550 items, we would have to take 100 items at $10, 200 items at $11, 250 items at $12, taking the oldest items first for costing purposes. The remaining 50 items would be at the most recent purchase of $12, so we would have cost of goods sold at September 10th of $6,200 and an ending inventory balance of $600. Then we take our last transaction of purchases and we add that back in to see how much is our cost of goods sold and our ending inventory balance at the end of the year. If we do LIFO, we do the same method, but if you look at the September 10th transaction, look what happens when we have the 550 items. Now what we do is that we cost it out at the 300 items at $12, 200 items at $11, and 50 items at $10. That would give us $6,300 in cost of goods sold and $500 remaining in inventory. Now let's take a minute here to take a look at this. If we had been doing LIFO using the periodic system, we would not have started with the $12 items. We actually would have waited till the end of December and used the November 27th transactions as the beginning of our calculation of cost of goods sold. So because we're using perpetual inventory, we are actually taking the cost from what's available at the time of sale, not at the end of the period. In the average costing, what happens is that we have to recalculate the average cost after every transaction. So after January, when we have the 100 items at $10, we have $1,000 in inventory. After April 15th, we have 300 items in inventory at a cost of $3,200, but the average cost is $10.67. When we have the increased cost in the purchases in August, we now have $6,800 worth of inventory and 600 items, so our average cost becomes $11.33. When we sell the item in September, we use the average cost that's been calculated at the time of the sale, the $11.33. So that's the reason why we have to consider using average cost in perpetual as a weighted average method, because we have to recalculate the average cost after every transaction. There's always a chance that we can make a mistake in the reporting of inventory on our financial statements. We could mistakenly count the inventory incorrectly, or we can apply pricing incorrectly. Also, there is a possibility that we could not recognize all the inventory as they are in transit at the end of the period. Remember that we talked about the FOB terms. Also, we have to understand that when we do make a mistake, the mistake is going to happen on two financial statements, not one. It could occur on the income statement as well as the balance sheet. Here's an example of what could happen on our financial statements if there was a mistake in our ending inventory. If we were to understate or overstate our beginning or ending inventory, it would have an effect on both our cost of goods sold as well as our net income. So inventory errors affect the computation of both the cost of goods sold and the net income for multiple periods. If you make a mistake in the ending inventory in one period, the mistake will carry over into the next period as the beginning inventory in the next period. So in other words, an inventory error could affect 2 years, not just one. So here's an example of what happens if we make a mistake. Notice in 2013 and 2014, because of an ending inventory error in 2013, which caused net income to be understated, in 2014, assuming that the ending inventory is correct, we would have $3,000 of an overstatement of net income because the beginning inventory was incorrect. There's also a balance sheet effect because if our ending inventory is over or understated, it will also affect our assets, liabilities, and our stockholders' equity. So take a look at what could happen if we make a mistake.